A lot of people, including us, have made parallels to what happened in 2015 and 2016. So there's a lot of nervousness over what happened in first quarter 2019, because, of course, in 2016, we saw a markets panic in China. We did not see that this quarter. We saw the opposite. And I think the Chinese have learned some of their lessons, some good, some bad, but there was unmistakable improvement in the economy in the first quarter. And one of the reasons people haven't gotten this is they're busy trying to navigate Lunar New Year and trying to figure out how does the February data compare to the March versus the June. We look at it from a quarter-on-quarter basis, and there was just a much improved atmosphere.
How much of that is because things got so bad in the quarter before? If you're looking quarter over quarter, is there a sign in saying, okay, maybe things troughed, but are we talking about a big rebound or not?
No, it's a good point. Q4 was worse than people understand. I mean, you look at a PMI and you see a 48 or a 49 number. What do you make of that? It was a lot worse than people understood in Q4. However, we also do the on-year, and on-year things are still improved quite considerably. So we're seeing better investment. We're seeing profits and revenue improve, and this is broad. So there were certain instances in which the on-year data were a little bit worse, but overall, you saw an improvement both on quarter and on year, which is notable.
Let's talk again about how you gather this data, because we have kind of been trained to not trust all the numbers that we hear from China as they officially report them. Well, how do you go about getting these numbers?
So in a nutshell, we survey thousands and thousands and thousands of corporates on the ground across sectors, across regions, private, state, micro, small, medium, large, every way you can break it down. And we ask them, what was your performance this quarter? What are you looking at going ahead? How is your hiring? How's your, what rates are you borrowing at? And we break this down. We aggregate the data and we break it down. But we don't use a middleman on this. We ask companies themselves, what exactly are you seeing and why?
To what extent was the rebound credit-driven this quarter, and does that concern you that it's not as pure a rebound as perhaps otherwise?
Yeah, it was overwhelmingly credit-driven. Now, look, in China, this is China, so every rally is a credit rally, and it's a stimulus-based rally. But the thing about this is you look at the credit data and it just pops out at you.
Folks, bring up the full screen too.
Yeah.
For this, yeah.
The borrowing here it matches the highest level we've seen since the mid-2013 Shibor panic, when people were, worrying about being access to capital. The borrowing is high. The credit costs are high. The types of firms that are getting access to capital is unusual. And so, look, in the short term, this is good. The question is how sustainable this is, and there's a lot of question marks on that.
Interesting, though, that you said that this happened specifically in regions with smaller economies. We're not talking Shanghai and Beijing.
Right. I mean, one of the things that people often do is there are more media and there are more hedge funds and there are more foreign companies based in Beijing and Shanghai. And so what happens in those cities is usually overinterpreted as being China. And what we're seeing here is that the larger cities did well, but not as well as some of the smaller cities. And so but the growth is broad. So this is an interesting look at an economy. It's not divided in half like we've seen it in parts of last year.
What's the key thing you're looking at as to whether this is sustainable, and roughly where are you coming out on expectations of GDP this year?
GDP is the hard question. I mean, we try to get away from that just because the Chinese are going to nail whatever number they want from a political narrative. We think they're going to keep it above 6 because they said they're going to keep it above 6. Does that mean things are stronger or weaker? No, it doesn't. So, look, what we're looking at always is hiring. We're looking at the credit situation, particularly borrowing numbers, and those are very alarming because they're just so broad and high, and everyone's taking a loan right now.
So it's not sustainable, you mean?
That part's not sustainable, particularly because credit costs went up. So usually when you see this type of lending, broad lending, they cut credit costs. But here you saw credit costs go up at banks, at shadow banks, in the bond market. They can't continue that. It can happen at the beginning of a rally, but it can't happen for several quarters in a row.